Sell in May and go away. It is actually very real. I'm going to look at that a little bit. We're going to look at seasonality cycles. I'm still looking at the presidential cycle of the first year of a new president, and it's playing out still in that pretty accurately. So we should have a little room to run. Sell in May is actually an end of May thing. It's not the beginning of May. So we have some time left for that. I think this market could actually still run a bit into that, although we're not totally out of the woods yet. We'll look at volatility. Fear is subsiding, but it's still elevated. So there's a couple things to be questioned about. I had a client send me a Wall Street Journal article about a 10-week moving average, and I was going to show you how that looks. I just thought it was interesting, so I might as well show it here. And we'll look at my current money flow stats. So that is the plan today. All right, so let's start with seasonality of the first year for president. So look at that. What was expected at the end of April into early May? Look at that. Just like that. A good jump up and a run. Not surprised after very messy. We had the sell-off in February into March. April actually did have a bit of a sell-off too, but it rebounded very quickly. And in the second half, it rebounded just like that. Actually, the bottom was around there on the 7th, if I recall. So we had a good spike up. And this is funny because this does not include this year. There's expected to be a good spike up and then a little volatility and then a good run up into around May 10th. Somewhere in that area, then a little more volatility, then back, chopping sideways, and then the summer. Summer always gets weird. So sell in May is actually the last day of May, and the sell in May period goes through October 31st. So it's usually, that's where you want to be buying over here. This is where you want to be selling, and this seasonality. Seasonally is a week period. It doesn't mean it's going to be down. It just means it could be choppy and sideways. So you want to just be paying attention to that situation. So that's where we are. It's amazing watching the seasonality play out because this is looking at the first year of the past 7 presidential cycles. So all kinds of variations in there, good markets, bad markets, and we're looking at a good blend of how those act. And it's just kind of playing out textbook wise, which is fascinating to watch. So I'm going to probably keep showing this every month this year just to see how it plays out. So volatility, as I showed last month, I believe we were right here, just coming off of this peak last time we had this webinar in April. And that was around the peak. And then we've slowly calmed down. That's usually what happens. So back here in August of last year, we had a big scary peak. It actually went higher than this recent one. And then it just quickly subsided. Now, this one hasn't subsided as quickly and not as far either. I'd like to see it back below the 20. This 20 line is about this area. And that usually means volatility is a little more calm. And generally under 16 is like super low volatility. The market's going to go up and you don't really stress about anything at that point. So, which is what we had, back in here. May, June, July of last year, just kind of grinding sideways below 16. That's a bull market. That's what it looks like. It's just no fear, just kind of continually grinds up at a slow pace. And then you get those fear spikes that come in, run early August, and what that looks like. And then we had another one, I believe, December of fear, and then it kind of calmed down. So you have these spikes of fear, and then it subsides, and then you kind of have to see where we are. So I'd love to see this pull down further. It certainly could as we go into May, but that's where we are. Again, I'd like to see it below 20 before I'm really a little more confident that the market's going to run. But so far, so good. Looking at the 10-week moving average. If you extrapolate that to a daily, that becomes a 50-day moving average. I think it's interesting when you hear people reference the week, because that's when you're looking at a chart where every bar is a week. Every single bar on here would be a week instead of a day. I like to look at days, but then kind of extrapolate looking at what would a weekly chart be on that. So a 10-week moving average on this chart would actually be a 50-day moving average. And that's what we're looking at here. And then fun down here, I've got the PPO. This is the Price Percentage Oscillator. And it's how far away is it from that mean. So, right, I've got the 50-day moving average here, and we're still just below it. I think today we might actually be back above it. But for this purposes, looks like the trend is still down. Even though we had the spike of fear and it's really relaxed, I want to see that fear go down further and push through this point. We could certainly get back up to here. I don't know if we're going to hit new highs or not before we hit new lows. At this point, it could go either way. I'd like to think it's going higher, but this trend is not favorable. Right? Usually becomes, as the market's going up, this line kind of becomes support before it jumps, blew through it, bounce, kind of right there. And then it started to go below it. Now it becomes the resistance, it becomes overhead from each side. So we've kind of touched there. If we go through it, that's a positive though. So I'm not super concerned now. I think we're in a good period. Both seasonality, the technicals are there, the sectors are there, and we'll get to that in a second. So our money flow indicators, we went back to positive right after that scary. And now what's wild is this drop over back here in what was December looked really ugly, but the market didn't do much. This looks similarly ugly, but the market sold off way, way worse. So it's fascinating watching participation. And what was interesting is when it started, it was really just the tech holdings that really drove this bull market in the past 2 years. They got hit first, but then as it played on, the more safe things, the values, they all got hit too. Not as much, but they held up as well. But there was definitely a shift to where everything participated. But now we're actually kind of grounding up. We're getting enough participation broad where we are above this 55-day on the advanced decline is what we're looking at. This is how many stocks are going up versus how many are going down. So we're actually doing all right there. Yesterday was down, even though the market was up. So I'll be curious to see how this plays out. If it drops below this line again, then we're probably going to be looking at a lockdown. Don't be too aggressive at this point. All right, on my money flow factor. So right there, I think it was around the 14th, we got a little money flow after this little fake out, right? So this was actually the tariff pause day where it was going to be 90-day pause, and then we had a little blip up, and then the next day was ugly, and then we've started to have this rally. And this showed me there was enough movement off of the bottom, this little green dot here, that we actually did get a little more aggressive at this point. But now we're peaking and rolling over. So if we get a new red dot, that's another thing for me to be like, let's back off. Let's not be too crazy aggressive. But for now, we're holding up. I think we're okay. This could keep going for a little while longer like it did here. It could just, money flow could go sideways, but the market could actually go up in that situation. So I'm not too concerned, but I'm watching for this new red dot of weakness so far off of a peak. Setup has started, but I don't think we're there yet. I think we have another week or two to get there. I don't normally show the major indexes, but I thought this was interesting. So this is my positive negative on the major stock market indices. So right now we have developed markets, emerging markets, small cap is on here too, but this we have Japan and Latin America is the ETF. So it's all international is what's been leading on this other side. Now small cap just popped over, I believe, a couple of days ago. On the MACD, it's been 9 days, and everything on the MACDs have been positive, but this is directional momentum, so there has to be a lot of momentum to be pushed to the side. So still we have the NASDAQ, S&P, mid-cap. The Dow is still one of the weaker ones, and China is actually weak. Oddly, having the weakest of all this group is China. Big surprise. I mean, that kind of makes sense with the whole tariff situation, but I'd love to see more of these move over to the positive side. They're not quite there. They're getting close. There's enough momentum. We're above the 8-day. This is the 8-day moving average. They're all above. So that's positive in the short term. But if these start rolling over, that's going to be a signal to start backing out. But for now, we're all good. But I still want to see momentum pick up on these. And then we could have a really good run for maybe 2, 3, 4, 5 weeks into the end of May. And then we hit that sell in May period, and then we'll see where we are at that point. Because you go back to sectors on the momentum, nothing. They are all on the right negative side, even though we've got several above their 8 days. We still have weakness in healthcare, real estate, and energy. Energy is getting wrecked. Even though this looks okay here, yesterday it was down a lot. So that's not encouraging. I want to see more participation again. But at the top of the list, we have tech, consumer discretionary, and communications, which is really just tech again. So when you have the tech being the leaders again, that's usually a good sign. I think we're in a good place. If these could just push over the line and move to the left, we might be in a good place for the entire market to run. Because why I like to look at this grouping of sectors is this is the S&P just broken down into a lot of pieces. So you can see what's participating and what isn't and where the strength is. And when they all agree that there's strength, then that's just fantastic for the overall market. So this is one thing giving me pause that there's not a lot of strength in the sectors. There's a little bit of short-term stuff here and there, but not super exciting. And just consumer discretionary, consumer staples, this should be a safety stack. This went negative a few days ago, and it looks ugly on the rotation charts as well. I'll show you that in the next one. But this is a defensive. So that's actually good. You want to see the offensive ones do well and this one be weak. So that makes sense. This whole setup makes sense for a good broad market move. And then finally, here's the XLP. I was showing you the consumer staples is weakening. It's pushing down into the weakening box. It's not there yet, so we're not super weak, but I love seeing all the sectors up in blue, pushing up into the green. So that could be another 5 to 10 days before they really get over here. And then you start going, okay, the weakness is here. But you think 2 weeks ago, they were all clustered down here in the bottom left in the lagging box. That's always a setup before they burst up into the blue. And that's how we got this run. And it just makes sense when you're watching these sectors all grouped together. So